If you can hear me, can you put a yes in the chat box, please? Okay, great. Finally got it on. Okay, great. Well, everyone, thanks so much for giving me your time this afternoon. I'm going to be talking about a really powerful options configuration that we've been using that has been really giving us, really providing us with tremendous performance. I'm going to show you exactly how it works, exactly why the risk to reward ratio that we get on every trade is really stellar, and how configurable the trade is in terms of options management. Just quickly, this mandatory disclaimer that all signals and trading opportunities we provide are for educational demonstration purposes only. Everyone understands that trading involves substantial risk and a person can lose a substantial amount of money. Always be careful when trading and never risk more than you can afford to lose. Now, I just wanted to introduce you briefly to the Right Line Trading team. You can see that it's growing. Geometrically, and there's a lot of young new talent here, and really proud of the company, and really adding a lot of new traders. Now, just a little bit about myself. I'm a graduate of an Ivy League university. I went to the University of Pennsylvania for 8 years. I majored in applied mathematics. I graduated summa cum laude with honors. After graduation, I was inducted into the Phi Beta Kappa Honor Society. It was always my goal in life to go into education, and at the termination of my training, I applied to a number of universities, and I went to Jefferson University in Philadelphia, where I became a full-time professor. While there, I published 15 peer-reviewed articles in top-tier journals. I taught an enormous number of undergraduate and graduate students. I've always considered myself to be a scientist and a teacher and an academician. And I've been invited speaker in many countries internationally and in many cities domestically. And I just estimate that I've mentored close to 30,000 traders over the course of the last 12 years. Now, one of the things I think that's really important in options trading is that you master one, maybe two strategies, instead of focusing in and mastering or trying to master multiple different ones. And I think that's one of the problems with options traders. They try to do complex strategies that are difficult to master. And as far as I'm concerned, I don't like to take any strategy that has multiple legs or multiple wings to it. Now, as General Patton said, use one steamroller strategy. Okay, you don't see anything on the screen. Let me reshoot. You should see now. Okay. Okay, great. We're going to use one strategy and we're going to stick with it. And we're going to become so facile at it that we're going to know exactly how to manage it. That's one of the things that the service is going to provide. We're not only going to get you into the trade, but we're going to manage the trade as it evolves. And that's what we're going to stick with. And the other thing about trading credit spreads is they are extremely friendly to small accounts. You do not need a large amount of money to trade spreads. In fact, you can trade credit spreads really effectively with $2,500 that you're willing to risk in an options account. Now, we treat options a lot like trading stocks. We meticulously manage all open positions. We're only going to trade liquid positions, and we're going to consistently utilize the same strategies. I'm going to show you exactly how we configure the trades, and I'm going to show you an example of a trade that is actually evolving right now. And it just so happened this morning that it gapped up 8%, and it looks like it's going to give us a 100% winner. I made this deck up a few days ago. I did not know it was going to do that, and it is turning into a real monster winner. Now, why learn credit spread option strategies? It really does give you a lot of leeway. You can profit on the trade if the stock price increases, decreases, or does not move at all. In fact, you're going to see that we don't need the stock to move up 1 penny from the point we take the trade to make 100% on our trade. Our loss is always limited. We never have to worry about blowing up a trade. The maximum loss that we can assume is delineated at the time we take the trade. So you know your upside and you know your downside. And it's a very, very simple strategy. The strategy itself is really all cookbook. Now, it's a strategy that I developed here at Rightline, but we're going to use the same one every time. So this is not going to be a black box system, and you're going to know my strategy. The key is finding the optimal stocks to trade. That's really sort of the secret component of trading credit spreads. Now, I've seen other services configure credit spreads, and they are just horrific as far as the risk to reward is. They will risk $1.60 to make 40 cents, or $1.40 to make 60 cents. We are not going to do that. I'm going to show you exactly how we work these trades. Now, stocks actually have 5 directions, and that's really, really important to note. 1, you can make the assumption that the stock is going to move essentially sideways in consolidation. Now I see there are questions in the chat box. A black box system, Bruce, is simply a trade where a trade is generated, but you don't know exactly what the components of the trade are, why the trade was chosen, what were the given rules that were followed in order to provide you with the trade. That's sort of a black box system. It's like it will spit a trade out to you, but will not give you any reason or rationale for why the trade was chosen. This is not going to be that kind of system, because I want you to learn how to trade the system and understand exactly why we picked a given stock and how that configuration of that stock really plays a key role in not only achieving a winner, but achieving a winner on exceedingly low risk. Okay? Now, it's important to note that every stock, as I said, has 5 directions. Now, one of those directions is that we can make the assumption that a stock is simply going to trade in consolidation, and factoring out slight market variation, it's not going to make any kind of move up or any kind of move down. Now, then we can make an assumption that the stock has a slightly bullish trend, but it's not going to make any major move up. We can do the same thing on the short side. We can say that a stock has a short bias, but it's not going to make any major move to the short side. And then we've got the direction that everyone understands, where a stock's going to make a strong bullish move or a strong bearish move. Now, if we look at the best way to trade these different biases we have based on a lot of technical and fundamental analysis. Now, if a stock is going to trade sideways, a credit spread is perfect to configure and use. If it's going to take a mildly bullish direction, credit spreads are awesome. It's going to take a mildly bearish direction. Credit spreads are really awesome. Remember, when we get into the trade, we don't need the underlying stock to move a dime in our direction. If it trades flat for the entire duration of the trade, we're going to make 100% of our money. Now, if we believe that the stock is going to make a strong bullish move or a strong bearish move, it obviously would be better to buy a call or buy a put on the trade. But these are really the only two trade configurations you need to pull consistent winners out of the money, out of the market. Now, sometimes we have a mildly bullish and the stock just skyrockets, as it did on the trade I'm going to show you. I didn't think it was going to take this strong of a move. But that's, if it happens to be that nice, all it does is make your trade sort of sweat-free. You don't have to worry about it. We're just going to move into options expiration. We're going to collect 100% of our net credit. Same thing with a move to the downside. So we've got a lot of leeway on the trade. It can trade from flat to slightly bearish to strongly bearish, flat to slightly bullish to strongly bullish. And we're going to make money in every direction. Now, if it trades against us, we have an enormous amount of leeway. And I'm going to show you how much leeway we get where we can still pull nice profit out of the trade. Now, the question that you have to ask yourself and the rationale behind taking credit spread positions is, now I hear all the time I get lots and lots of emails, all the marketers say, you never want to be a buyer of options. All the smart money sells options. And that is completely untrue. There are periods of time where being a buyer of an option is extremely advantageous. And there are certain times where selling options is the way to go. Now, we all know that the market is an auction-based system. Now, consider that you're standing at the podium. You can be standing at the podium, or you can be standing in the or sitting in the audience of an auction. Now, when do you want to be the buyer, where you're sitting in the audience and you're paying a fee for what is being auctioned? And when do you want to be the auctioneer or the seller and selling something and let somebody in the audience buy it? And you collect a fee for selling it. And that's really the thing, that's really the process that should be going through your head. Do I want to sit in the audience and be a buyer? or do I want to be up at the podium and be the seller? And the way we look at it is really extremely simple. Now, you want to be the buyer when the cost of what's being sold or what's up for auction is really low. So if the price of the option is really, really cheap, we want to buy it. If the price of the option is really expensive, we want to sell it to somebody else. Let them have it. And they're going to pay us a fee for taking control of the option spread we sell to them. So we're going to be looking for expensive options to sell to someone else. And that's going to provide us with a huge credit on the trade and give us an exceedingly nice profit and really a nice cushion on the trade as well. So it's not true that you always want to be a seller. You're not going to sell a cheap option. If you have a really strong feeling for how the stock is going to move out into the future and the price of those options are really, really cheap, you're going to buy them. But if they're really, really expensive, you're going to dump them off to someone else. Now, when is the cost of an option low? It's almost always when implied volatility is low. What the market is doing is pricing into the option the fact that they do not believe the option is going to take a big move. Now, there are obviously multiple other metrics, but the one that controls options price the most is IV rank or implied volatility. And when the cost of the option is high, implied volatility or IV rank is almost always exceedingly high. Now, I'm going to give you the IV rank metric on every trade that we take. In fact, I'm going to give you all of the relevant metrics on a trade we take. Now, I don't have a slide on how the trade looks at the time we take it. Actually, I do, but I left those metrics out. But you're going to get the maximum potential reward, the maximal potential risk, the IV rank, and a whole host of other metrics, so you can understand exactly why I've chosen that stock and that particular trade configuration. Because I want you to ultimately at some point, and we do educational sessions. We had one on how to repair a credit spread. And actually repairing them is super simple. And you can really turn a loser into a very, very big winner. And I did about 2.5 hours on that. And we have an educational session that's scheduled. And that is an educational session that's not open to anyone else but members of the service. And you're going to learn a lot about how to trade options in general and how to manage these trades. Although I'm going to do all that work for you. Now, we want to buy a stock that's sitting with a huge volatility bubble, and that volatility inflates price. And our assumption, and it almost always happens, is that we've got that arrow and it's heading into volatility. Now, we sold the option when it was exceedingly expensive and volatility was very high, and we let somebody else have it. Then that arrow comes, hits, pops the bubble, volatility deflates, and immediately, without the stock or the underlying stock moving a cent, the value of the spread we sold drops precipitously. And when you sell something, you want its value to fall. So ultimately, if you have to buy it back, you're going to buy it back for pennies on the dollar. So we want that option spread that we sell to basically expire worthless, or if we wind up having to buy it back, we're going to buy it back super cheap. So if we sold it for $5, we're going to buy it back for 80 cents. So that's how important it is that volatility just leaks out of the spread continuously as we move through the period of time that we've sold the credit spread. Now, these are all the critically important metrics that we look at when selling options. Obviously, we have to pick a direction. It doesn't have to be strongly bullish. It can be mildly bullish. And as you know, it can be flat. Even though we have a bullish anticipation, it doesn't even have to move up. Like I said, all it has to do is move up a nickel, really a penny, and we will make 100% of the credit we got when we sold the spread. Now, the expiration date is critical. Now, just to mention really briefly, I don't want to get ahead of myself, we're going to sell puts when we're bullish, and we're going to sell calls when we're bearish. Now, the two arms of a bullish trade is we're going to sell one put and we're going to buy one put. The two arms of a bearish trade are we're going to sell one call and we're going to buy one call. Obviously, the premium that we get is exceedingly important. The premium width is important. The premium percentage is important. And the IV rank is critical. Now, I'm going to give you all this information on every trade we take, and then you're going to get multiple updates a week. On the credit spread service, I've already sent out 3 emails or alerts this week to update all the members on exactly what we're doing, our positions, I already have a profit target set for every position that I have. Everything is really done for you. And as I said, through the educational sessions that I'm going to provide you, you're going to learn how to take these trades, hopefully just as well as I do. Now, this is a little bit blurry, but it just reiterates what I said before. When we're taking a bearish position, we're going to use calls. And then we take a bullish position, we're going to use puts. And I'm going to show you the recipe. Now, in general, we're going to trade options that are 45 days to expiration. Now, I configured a trade and sent it out this week on SCMI. And I'll tell you the ticker. I'll tell you the name of the stock always, the exact name of the stock always, and it was one of the best spreads. It's Super Microcomputer. And the day that I sent out the spread, Super Microcomputer went up $30. So we missed the trade. But on that particular trade, what I did was I configured a 90-day expiration, simply because of the configuration and the huge amount of credit that we would have gotten if we would have nailed that trade. It just didn't blow up $30 in one day. And it was one of the biggest movers in the NASDAQ that day. We would have gotten a tremendously advantageous trade. But in general, We're looking for options that are 45 days to expiration. Now, we're always going to sell the 50 delta, and we're going to buy the 25 delta. Now, if we're bullish, we're going to sell the 50 delta put, and we're going to buy the 25 delta put. If we're bearish, we're going to sell the 50 delta call, and we're going to buy the 50 delta call. Now, configuring these is super easy once you've decided on the stock you want to trade and you've looked at all the metrics. Now, the credit distance between strikes has got to be at least 33%. I shoot for 40 to 45%, so that we really only have to win about 45% of our trades. I'm sorry, about 55% of our trades to be at break even. We're running at about an 85% win rate. In fact, I've only taken one loser in the past 2 months. I'm going to show you those trades. So we are way in the green. Now, I know a lot of this may seem a little bit, difficult to grasp. And it's a lot of information, but like I said, I don't want to give you kind of a fluff webinar where I just wax on about, the trip I took to, to Costa Rica. I want to give you really a lot of information. Now, all of this stuff is going to slowly be assimilated as we take trade after trade and we do educational session after educational session. So don't worry about mastering all this right now. I just want to make sure that you see exactly what we do so you understand all the trade configurations and why I take them. Now, I'm going to show you a trade I took on McEwen Mining. Now, McEwen Mining has just become a tremendous winner. Now, I'm going to tell you where it's trading right now. It's trading at $7.90. Now, all we needed was for McEwen Mining to trade at $7 or greater. Now, $7.90 on a $7 stock is a tremendous percentage. And what I'm going to do is I'm going to drop the deck for a second, and I'm going to bring over a slide that I have right here. And I'm going to open it up and pin it. Now, here's the same trade that you just saw, only now we can draw on it a little bit easier. Now, when I took the trade, it was what I did was I sold the $7 put. That was the 50 delta right here. And I bought the $6 put, which was the 25 delta. Now we got 45 cents of net credit on a $1 wide spread. Now we could take a $6, $7. Another trade could be a $5, $10. The narrower the credit spread, the better we are, because we have more ways to configure. So the full length of this trade right here is $1. Now, why is that advantageous? Let's say that you want to risk on every trade say $500. That's the most you will risk per trade. That's very important on every trade, that you take equal risk on every trade, because that's the only way you can trade profitably. You have to pick a number, it does not matter. It's based on the size of your account. You can take $250 a risk, $500 a risk, $1,000 a risk, and you're gonna buy the number of spreads that ultimately equal the risk. Now, the reward on the trade, maximum $45. Maximum risk is $55. Now, on a credit spread, that is an amazing risk to reward. Most credit spreads and most credit spread traders look for 33%. Some of them trade with 25 and 20%. And we're looking here at a 45% potential profit. So this is a tremendously advantageous trade. Now, at the end, as the trade matures, here's our 45 cents, because here's our $7 level right here. Now, when we bought it, McEwen was trading at 7. So we do not need it to move up a penny. As it is, it's almost up to 8. So this is going to be a 100% winner. We're going to collect all 45 cents now, or $45. Now, if you could take, say, $500 of risk, you could have traded close to 10 spreads, because your risk on the trade right here, again, is $55. So if you can afford $550 of risk, you can take 10 spreads, and those 10 spreads are going to give you a $450 winner. Now, this area right here is the margin of error we have. Now, the stock can trade all the way down to $6.55 at expiration, and that's where we're at break even, right here at $6.55, because we have $45 or 45 cents of cushion, and that's right here. So we have an enormous amount of leeway on the trade, and ultimately at expiration, if it's trading in here, we're going to make not 100% of our potential net credit, but we're going to make a nice piece of that 45 cents or $45. If it trades below here, the worst we can possibly do at expiration is lose $55. Now, if we win 85% of our trades, and that's been the track record, you can see how you're going to get a really nice green portfolio. Now, the reason I took McEwen Mining was because the only way to get 45 cents of net credit was for McEwen, and I don't have the metric up, had for some reason tremendous implied volatility. Now McEwen Mining mines not only gold, but it mines a lot of other precious metals. It also mines copper and some trace minerals, really important ones. I really felt that McEwen Mining, given the geopolitical instability in the world, a lot of the fundamentals. Now McEwen had pulled all the way back from 15 to support, and that support was $7. I took it at 7, and it has rocketed off support, and this is going to evolve into one of our big winners. But the maximum risk on the trade is 55 cents to make 45 cents. And on a credit spread, that is an outstanding risk to reward. I was just listening to a webinar. It was sort of a market recap from another company. They traded a spread where they were looking for 40 cents on a $2 wide. They were risking $1.60 to make 40 cents. We're risking 55 cents to make 45 cents. Just an outstanding risk to reward. So I'm going to close this up. I'm not going to save it. Well, I'll save it just in case there's a question. So you see all the metrics on the trade. I'm going to go through I'm going to just skip all this because this is what I just did on the, now I just wanted to also mention, this is really one of the, a credit spread is one of the most sort of type of options positions that can really be marketed in a very, very sort of underhanded way. We trade a 50 delta spread, so that if we just had a dartboard up and we were throwing darts at the board, we would win 50% of our trades and we would lose 50% of our trades. That's what the market's pricing in. We are selling the 50 delta. If we're bullish, we sell the 50 delta put, and if we're bearish, we sell the 50 delta call. What if you sell a 10 delta call? If you sell deeply out of the money credit spreads, and that's what I was showing here. Let me see where it is. Right here, you can risk $9 to make $1. And you're going to, if you sell a spread that is that far out of the money, you're going to have a tremendous number of winners. But then one loser is going to wipe out 9 winners. And this is done repeatedly because when you market it, it looks unbelievable with almost a 90% win rate. But this is going to send you to the poorhouse. It's going to destroy your account, because at some point in time, you're going to get 2 losers in a row, and then you're going to be behind the 8 ball. And then at some point in time, you're going to get 3 losers in a row. It's unlikely, but it happens. So you never want to take deeply out of the monies. The most advantageous trades are taking 50 delta spreads, and I've been doing this for over 20 years. And I'm telling you, you trade deeply out of the monies. They look great on paper, but they do not treat your trading account very well. Now, what we do on the configuration that I like the most, now there's all kinds of trade configurations. I also like to trade a consolidative pattern, but this is called a frying pan bottom. I like trading them because they take into account a huge amount of sentiment of traders. They go back a long way. And here's a nice 42, now this is a 42% return on the stock on Cisco Systems off of a frying pan bottom, right up to resistance. And here's on Ontario Resources, 40% return on the stock, right off a rounded bottom and a move up, and then it broke out and went even further. Here's Caesars Entertainment off a frying pan bottom. Now, since it hit resistance here, it ultimately failed, came back. We were already out with a 25% return on the stock. Now, the best practices of credit spreads, and in general, I adhere to it, although obviously some of these things are mutable. On McEwen, we're going to go for 100% of our max gain. We exit if we hit 75%. And we're going to put a stop on the trade that's equal to 75% of our max gain. So though the math tells us that we can lose a little bit more than we can win, we're going to put a stop in that makes it, at worst, you can only lose on the trade what you stand to gain. And then we're going to exit the trade in general, and these are all in general, because on the McEwen that I just showed you, we're going to take it right into expiration, let the spread expire worthless, and keep 100% of our credit. But moving 14 days into expiration, you get what's called gamma whip. And that means that a slight move in the price of the underlying stock causes a tremendous change in the value of the options, because all of the extrinsic value is leaked from the option. And the gamma of the trade just really, really goes high. We don't want to deal with that. And I'll give you an example of why we don't take it, of why we, around 14 days into expiration, we start looking to close the trade, although if we're deeply, deeply in the green, we'll hold, is that something can come out, and I'll give you a great example. And this happened to me about 5 to 6 years ago. I took a deeply out of the money spread on Walt Disney, and believe me, I learned everything from experience. And I was up 99% on the trade. I figured I would just let it expire worthless on a Friday. Was options expiration. Friday morning, a boutique brokerage came out. They crushed the stock. I mean, they just said it was like the worst thing to own in history. And Walt Disney took its biggest down move in 20 years. I lost $40,000 on that trade. So I went from a 99% winner that I could have folded up and taken off the table to a monster loser. The other thing about trading tighter into 14 days is we don't have an opportunity to repair a trade that is not moving in our direction. Now, I spent 2.5 hours talking about the multiple ways that we can take a trade that's not going in our direction and repairing it, and slightly changing its configuration to provide us with a winner on what may look like a loser. Now, if we don't touch the trade and we just leave it alone, we have our max loss, and that's the worst we can do. But if I see a trade that goes strongly against us, and we've only had one go against us in a long time, and that was Lockheed Martin, which just came out, and there was a notice about a delivery of their F-35s. And in 2023, they're only going to deliver 85 instead of the projected 150. And Lockheed Martin just absolutely fell through the floor. Now, we still cannot lose more than our maximum loss. but Lockheed Martin had multiple ways to repair it, so we could walk away with an enormous amount of profit. And I went through that in that educational session. But in general, we want to avoid gamma whip and avoid those last 14 days because we don't have enough time to repair it. Send it to the operating room and have some surgery done so we can still walk away with a nice winner. Now, here's the gamma, and here's what happens as we close in on those 14 days. It just skyrockets. We want to avoid that. Now, I have a scanner, which I will go through you in the educational session. What it does is it looks at the direction, it looks at the kind of trade, it gives you the wings, it tells you the sell, the buy, it gives you the premium. You see the 44%, 44%, 42.5%. This is our net credit. We want to take a spread that gives us at least 40%. On the Q in mining, I got 45%. I'm always going to look for 40% or more. And this is a start because every one of these trades need to be vetted. This is just an algorithm pouring out the data. I have to look at every one of these trades, and oftentimes I'm going to take a trade that's not even on the scanner. But the scanner is certainly a great starting point. I'll show you how to configure it. I'll show you how to work it, and I will show you how to vet the trades. But it's a great launching point, and we're going to do that in one of our upcoming educational sessions. Now, I just wanted to show you a couple of our recent winners. Valero, we made 80%, Phillips 66, 70%, Diamondback Energy 67%. Now, I took a spread on the IPATH Series B VIX when the market just took a big dive, and I considered that everyone would take more than one spread. So let's say you took two spreads. You would close one at a 50% profit, one at a 91% profit. On Sigma Lithium, same thing. Took it short, closed one position with a 28% profit, one position with a 50% profit. Our current open trades are McEwen Mining, doing absolutely fabulous. It looks like we're going to make 100%. Marathon Oil after today is through the roof. Now, Uber is very volatile, and we just took it. It's too early to give you a prognosis because it's jumping around a lot, but we have a really wide spread on it. I think Uber, we have a 40% margin for error. And I don't remember the exact amount. I think we made $1.65 on a 5-wide spread. So the math is with us, and it's really too early to determine how Uber's ultimately going to do. I would have liked to see it. Actually, Uber initially traded really strong. Now it's pulled back some in this market, so we're just going to have to see. But MUX and MRO look very solid, and we could take MUX off the table right now, but I'm going to leave it on. And the way just the geopolitical conditions going on in the Middle East, we're going to hang in there with Marathon Oil. Now, what I do when I take trades is I look for the best performing sector. Now at the time I made the slide, it was energy, and one can still consider it to be energy. I look at the best performing subsector within energy, which is oil services and drillers. And I find the best stocks within these subsectors. And then what I have to do is I have to go through each one, and I have to look at the net credit we can get by selling the 50 and buying the 25. If we're bullish, I use puts. If we're bearish, I use calls. So it's a little bit of it's a time consumer, but if we drill down, so to speak, on the sector or subsector we like, or in a particular stock, like super semiconductor, SCMI, I knew it was going to rocket off. I just got in one day too late. And the day I configured the trade and sent it out was the day it went up 30 bucks. We would have been in one day earlier. We pretty much would have locked in 100% of our credit. I mean, that's just the way it goes. But that's my trading methodology. Now, here's how the scanner looks. If you snapshot it in color, and you can see that these are, at the time, these were all bullish trades, and you can look at the premium width. That's what's key. IV rank is really important. You always want to know about earnings, because you never want to trade a credit spread into earnings. It's way too dangerous. It can lock in 100% winner, but it can take a winner and rocket it right into a loser. We want to take all variables into consideration, and earnings is a variable that we oftentimes can't control. So we're always going to know earnings, and we're going to trade these credit spreads around earnings. A lot of times we can trade them into earnings on the anticipation that traders are going to consider that the stock is going to beat its earnings consensus. And remember, as you approach earnings, volatility tends to get very high. So trading into earnings can be very advantageous, but we do not hold through earnings. This is how the scanner looks. So I'm going to give you, this is the offer. Now, I put 2 optimized credit spreads sent to your email inbox every Sunday, but I really don't want to mislead you. What I've been doing is I've been sending out 1, because I don't want to accumulate too many spreads at once. We have a whole bunch coming up for expiration. I want to take them off the table because I don't want to stress out your account. Let's say that you decide to take $500 of risk for every trade that we take. And like I said, the 500 is totally arbitrary. You could take $250 of risk or $1,000 of risk. It's going to be commensurate with the size of your trading account. But every time we take a trade, you must take that $250 of risk, or that 500, or the 1,000, so you can monetize the trade. So I don't want to leave too many open trades out there. So I've cut back to 1, and we will have a trade go out on Sunday. I'm probably only going to send out 1. Now, I'm going to give you every metric. And if anything, I'm probably too obsessive compulsive. I send out too many emails on the credit spread service. I know I sent out 3 this week. Now, you're going to get the entry price is really the net credit we're looking for. You're going to put it in a limit. You're going to get the stop and all targets. Once we execute the trade, everything is going to go up. And I'm really going to give you frequent updates. And every now and then when we have to repair a trade, we're going to do it. And you're going to understand exactly what we're doing. It's really not that hard. So you get lots of intra-week updates if there's any major change in price in the underlying stock. We're going to do bi-monthly live credit spread training education, and it's only going to be for members. I'm not sending out general invitations, to 50,000 people to come in. This is education for you only. And I want you not only to make money on the trades I take, I want you to learn how to do what I do and be able to do it just as easily. And I'm going to really put you on a geometric learning curve. Now, I just want you to know one thing that's rare about the service is that I take every trade I recommend. Now, you're not going to hear anybody else make that representation that, oh yeah, well, I'm tossing out trades to you, but I don't want to take them. They're for you. They're not going to say they take the trades they offer you. I take every trade I offer you, and I asset allocate accordingly based on the size of my account. The amount is really irrelevant. It may be a lot larger or a lot smaller than what you're going to do, but it's equal across every single trade. And what makes that so important is that I just don't throw out trades to you and then it's sort of like, okay, well, I hope it makes them money. It doesn't matter to me. Well, it matters to me a lot, because every morning when I open my Thinkorswim account, I want to see those trades moving into the green. I want to see my net credit start to accumulate, and I want to make money. Now, this is really a special we have never run before. Now, the first month is only $21. It's normally $91 a month. So as an inaugural month, 21 bucks. You don't like it, I don't make you money. You cancel anytime in the first month, you'll never be rebilled. So that is your total risk on all the work that I do to give you great trades. And I really do an extensive amount of work. I put my heart and soul into this service because it's important to my own account. And then annual is $7.91. That's normally $12.91. So the very, very little money to come aboard. See the trades I take. I think you will love them. I think they're going to make you money. And I think you're going to wind up in the first month paying for an annual subscription. I mean, that's just my guess. I can't tell you for sure because I don't know how much money you're going to risk on every trade. I can just tell you historically, we're trading at an 85% win rate. So let me answer any questions that there are. That's right. Only $21 for the first month, and that is it. The newsletters, the flagship newsletter comes out on Sunday night, and you're going to get multiple weekly updates. I mean, Sunday night is when I really review every open position. I give you a nice critique on where we are, what I anticipate on the trade. And then during the week, I'm going to send out briefer, but very specific updates on every trade that we have. The link to join should be in the room. Are you there, Rory?
Yes, the link is in the chat box, Mark.
Okay, great, thank you. Okay, the link's in the chat box. Okay, Manny? Okay, Raj? Alan, Victor, Maria? You should see it. If perchance you miss it, an email will go out very shortly. Tomorrow, you'll get a replay and another opportunity to join. That's going to be the last one. Okay, great to have you aboard. Do you search? Do you teach actually how? I'm going to teach you exactly how to enter the position. It's really, really easy how to enter. Remember, I'm going to give you on the spread both legs, and you're going to tell your broker. Let me go back to the trade on MUX. You just say to your broker, I want to sell November 17, 2023, $7 put. I want to buy to open the November 17, 2023, $6 put. and I want a net credit limit of 45 cents. And that's what, so you're gonna give both arms of the trade, the $6, $7, you're gonna sell, but I'm gonna give you this information in the newsletter. It's gonna tell you what to tell your broker. You're gonna take the trade in its entirety. You do not buy each wing individually. You buy the spread or you sell the spread, and then you demand from the market 45 cents of credit when you sell it. That's what you want someone to give you for taking it off your hands. On MUX, I think we had to wait a day or two before it hit 45 cents. You just leave it in as a limit order. Hopefully it will ka-ching in, and then we're rocking. So configuring the trades and telling your broker what to do is really very easy. I would open up my Thinkorswim platform and show you how to trade it, and show you how to do it. It's really simple, but you can just phone it in, and I'm sure it's a very cheap amount of money to phone in. On Thinkorswim, if you do them on your platform, I think there may be no commission, but they're really simple to take. Okay, can I trail, then add to make what level? Okay, the level you need, Ray, is to be able to trade spreads. Let me go back to the first question here. Hang on, it's not they're going off a little bit. Hey, Toby. Yes, like I said, I'm going to teach you how to take these trades. But you know what? When you get the newsletter, you're going to see everything. It's going to be crystal clear how to take the trade. As I said, just tell your broker that you want to take a credit spread trade. You give them both wings, and I'm going to give you all that information in the newsletter. Hey, Bruce. I saw AMT on your the list though, Bruce, was way back. I mean, that trade that the scanner that you saw that I shot that a few months ago. So don't use that. Don't use that as any kind of metric. I just wanted to sort of give you an example of how the scanner looks. It really wasn't an example of any particular trade we might take today. So applied materials is something I would definitely look as more of a bullish trade. But I haven't really looked at applied materials at all, to be perfectly honest with you. Can I trail that add manual after the first month? Yes, you can. Yep, you mostly can, Alan. What level? And level, Ray, is you need to be able to trade spreads. I mean, there's one level where you can just trade puts and calls. If you've been trading puts and calls for a significant period of time, almost all brokers will allow you to upgrade to spread trading. And remember, when you tell them you want to spread trade, tell them that you don't want to spread trade on margin. You want to trade spread on cash. And that gives them, that sort of gives them a sigh of relief. But they know, like you know, that there's a fixed amount of money you can lose on the trade. We're not selling naked puts or selling naked calls. On MUX, the most you can lose with $55 a spread. So you're not taking any trade with an unlimited loss potential. So that also provides them with, a level of security. So, but just say you're trading cash, you don't want to trade spreads on margin. I wouldn't trade any options on margin anyway. I mean, maybe a long-term stock hold, but you're paying interest on your margin. So I would try to stay away from it. Hey, Mervin, are there occasions that you get filled? No, listen. I mean, and then let's see, Mervin, that's a good question. Are there occasions where I get filled, but everyone else doesn't get filled? I've never had anybody email me and tell me that. I'll be honest. I'll give you. I mean, I get a ton of emails and a ton of questions and Feel free to always email me if you have any question about any trade as it evolves, as we take it. I've never had somebody say to me, you know, I log it in as an entry because I got filled at the price that I put up in the newsletter, but somebody else doesn't. It's exceedingly rare. Remember, we're trading liquid options. So it's not going to be where, you know, 3 people out there are going to get filled. If I get filled, likely everybody is. And it's probably going to trade where you could have gotten a net credit of 46 cents very briefly to fill everyone at 45. I'd be very confident of that. And if that were an issue, I would tell you. After 21, now after 21, it will recur at 91. But if you don't think it's worth it, you have 30 days to cancel. So, you know, you're only risking 21 bucks. And in the course of the month, you're going to get a lot of trades. And you're going to see exactly how they're managed, exactly how they work. And, you know, I'm not a betting man, but I would be, I'm inclined to think that you're going to really love the service. Hey, Peter, my pleasure. Yep. Now, the account size minimum, Alan, I mean, really, you can have a really tiny account. It all depends on, listen, a tiny account's gonna give you a small, on a small account, your ROI, or return on investment, is gonna be equal to somebody trading an enormous account. If you start with a small account, you're obviously going to make a smaller amount of money. You risk more, you win more, especially with an 85% win rate and the metrics that we work with. But really, I would say you need about $1,500 to $2,000 because we may have 3 or 4 open trades, maybe even 5, and you want to asset allocate across those open trades. That's why I'm a little hesitant. That's why I'm not sending out 2 trades. I don't want to throw too many open trades and stress out people who have a smaller account, or even someone with a large account. Let's say you take $5,000, asset allocate $5,000 per trade. I don't think you want to have 6 or 7 trades. We have $35,000 hanging out still in the market. There always could be something awful that happens, some geopolitical monstrosity. So you never want to have too many open positions. We're going to hold them around 4 to 5. Yep, cash account only, Ray, you shouldn't have any problems. After the 3rd day, you can sign up. After the 3rd day, you can sign up for the annual. How long is the offer open? It's open for today and tomorrow, John. You're going to get a letter today with it, and you're going to get the replay tomorrow with the offer again. After that, the $21 is over, and you're going to have to come in at the 91 bucks. So, you know, it's a 2-day offer. You know, I'm not one of those. You got to buy in the next 22 seconds, and I don't do a countdown. You have today and tomorrow to come aboard. I'm telling you, for 21 bucks, you really, really can't go wrong. I'm telling you, I send out great trades, and I really, really work hard on these trades. 45 days to entry, Alan. I'm going to close in general in about 30 days. Maybe I'm going to go 35, and on McEwen Mining, which is up so much, I'm probably going to hold that the full 45. But that's extremely rare. Most other trades, I'm going to close about 30 to 35 days into the position. If we like the service at the monthly, yes, you can then roll it at the annual. If you come in at the 21, we will hold the lower price for the annual for you. Hey, Bruce, at 21 and switch to, yes, you can. Everybody's asking that, you can do that. It's 91. I hear you talking about it now, but I didn't hear it. Okay, well, the answer is yes. If you come in at the $21 and you really love the service, we will still offer you the lower price on the annual. Ray, I rarely do, because remember, we're subject to gamma whip. Now, let's say, I'm just going to give you a quick example. Let's say on MUX, the day before options expiration, we're up 99% on the trade, and something really unusual comes out. You know, some broker says the stock's going bankrupt. Some broker says they're cooking their books. You just never know what can happen. And because you're so close to options expiration, there's so many ways that we can turn a loser into winner when we repair a spread. We don't have to repair many, I can tell you that. But if something like that happens 14 days out, we got plenty of time to make an adjustment. It happens the day before options expiration, they've cut your throat. That's why I don't like to go right to the end, even if it means giving up a couple of percent of our net credit. Okay, I missed that one word, but I just wasn't sure if this was a blank service, but that's what we're going to do, right? And listen, I'm trading them with you. I'm going to give you my recommendations. Listen, I got burnt once and I lost 40K on one trade. I just don't want that to happen to me again. I don't want it to happen to any of you. As we move into the options expiration date, yep, I did on Walt Disney. I was sitting in the CVS pharmacy getting a prescription filled. When I saw what happened with Walt Disney, and I felt like begging the pharmacist for about 34 Valium. And I was so unhappy, so angry at myself for not closing the trade 2 or 3 days earlier and walking away with a huge winner. But that's what you do when you mess. You just can't do it, and that's why we're not doing it. And moving into 14 days into expiration, we start seeing that orange light. And then if we get a little bit tighter, we probably close the trade, take 80 to 90% of our credit, bank it, and move on to the next trade. So listen, everyone, thank you so much for giving me your time. I really look forward to working with you. I promise you terrific trades. Obviously, I can make no guarantee, but I want to make money. I want to be a successful trader for you. I've been doing this for 20 years. I know all my numbers. I know the best way to configure. I know the best way to repair. And we can turn a big loser into a big winner, I'll tell you. And we're going to do an educational session every 2 weeks. And in that format, we'll have open chat, and we can really hone down on a specific topic and really make all of you really better traders. Just in general, how you manipulate options, we're going to go over that really extensively. So everybody have a really wonderful weekend. I thank you so much again for giving me your time. And again, I really hope to be working with you. Take care, everyone. Be safe. Enjoy yourself. And hopefully you'll get that Sunday evening newsletter. Take care, everybody. Bye-bye. My pleasure. Thank you. Thank you. Thank you, Yuli. Bye-bye.